It's another episode of Africa Business Weekly where we bring you exclusive conversations with the continent's most innovative entrepreneurs, business leaders who share their views and opinions on developments in Africa's business landscape. I'm your host, Akin Obakeye. Hello and welcome. This week, we'll touch on monetary policy decisions in Rwanda, then shift gears to unpacking the impact of Botswana's 2025 budget on the country's economy, and of course, find out more on the $46 million credit facility by the International Monetary Fund for Liberia. So let's get the show started from the eastern part of the continent where Tabitha Muthoni is on standby to give us more.
Thank you, Akin. East Africa saw most countries table their MPCs from Kenya, Uganda, followed by Rwanda, amid global economic uncertainties, inflationary pressures, and shifting monetary policies. Rwanda's central bank went ahead and maintained policy rate at 6.5% for the first quarter of 2025. Here is more.
The global landscape, I think the economy is stabilized at the global level. Our main interest on the inflation, the global inflation, has been going down. Last year I think it was 5.7, expected to go to be 4.2 2025 and go down to 3.5 next year. So that pressure on imported inflation has really eased. And when it comes to our domestic economy, the economy has been performing well in real term. The growth has been strong for the last year was the fourth year. We haven't had the final numbers for the year, but the first 3 quarters of last year, the economy was growing at 9.2%. And when we look at the frequent numbers we track for the fourth quarter, it is expected to remain strong. So overall, we expect the economy to perform above the 8.3 projections we had from last November projections. On the inflation side, again, with the global inflation easing, with our agriculture performance, good agriculture performance last year, we saw inflation easing from an average of 14% in 2023 to an average of 4.8% last year within our band, which is a very positive development. We expect this to continue this year. We will expect inflation to remain contained within our band of 2 to 8 at an average of 6.5% this year. And because of that, we assessed that maintaining the policy rate at 6.5% is optimal to maintain inflation within our band of 2 to 8%.
All right. And Governor, the conversation around inflation is not only a Rwanda affair. We are seeing inflation still dominating most of the central bankers in the region in terms of how do these factors play out. And just looking at the numbers you shared with us, and currently there are a couple of risks that might further see inflation sort of edge upwards. Have you made your assessment on this, and perhaps what likely interventions might come along as you look forward to the next review period?
Yeah, I think it's not just in the region, across the world. Yeah. The preoccupation of central banks as monetary authorities is inflation. Our objective, our main mandate is to maintain price stability, and that is measured through inflation. So you hear that across the world. But in the region, generally speaking, inflation has been low within, in fact, almost all of us had, apart from one country, we had inflation below 5% for last year. And I haven't looked at the projections for my colleagues, but it is expected to remain moderate even this year and the next year. As I said, for us next year, we're projecting 4.1%. But these projections are based on, one, normal agriculture performance. So as you saw, we always put a caveat. This is based on normal agriculture performance projections. Yeah. It might be affected by adverse weather conditions that we are not seeing right now. If it happens, we will say we will take action. And action, not just monetary authority, but we expect other responsible authorities to take action as to address issues as they arise. So the biggest challenges we have to our inflation path is weather conditions and geopolitical tensions, global and in the region. And so we always put that caveat that if anything happens, then we'll have to take corrective actions as monetary authority.
To more developments in Addis Ababa, the current financial architecture needs restructuring if Africa is to play a proactive role on the global stage. African foreign affairs ministers are rooting for sustained reforms in the trade, climate and financial ecosystems. Here is more from Clever Gatete, Executive Secretary of the United Nations Economic Commission for Africa.
Africa's current global financial standing reveals the stark inequalities it faces. The continent possesses 30% of the world's mineral reserves, including 40% of the gold and up to 90% of its chromium and platinum. It also contains as much as 65% of the world's arable land, yet Africa accounts for less than 3% of global trade and only 1% of global manufacturing output. Furthermore, in 2023, for example, intra-African trade stood at just 16% compared to the intra-European trade at 68%. Moreover, it is unjust that the entire African continent has an IMF shareholding equal to one of a single country, Germany. These disparities are not just due to lack of economic potential, but to entrenched structural barriers that keep Africa in a cycle of economic dependency. Distinguished delegates, in addition to this, the injustice extends to Africa's credit ratings, which are dominated by external agencies that sometimes apply unfair and subjective assessments to African economies. As we speak, only 2 countries, Botswana and Mauritius, hold investment-grade ratings, while others, despite sound economic fundamentals, are burdened with high risk levels. This situation inflames borrowing costs, stifles investment, and keeps African economies locked in debt cycles. Added to these economic disparities is the fact that although Africa contributed the least to climate change, it is suffering the most from its effects. Currently, climate change is costing Africa up to 5% of GDP. Yet, of the $10 trillion invested in globally in clean energy between 2015 and 2022, Africa received only 2%. However, this must change. Africa cannot build prosperity on a foundation designed to constrain its growth. To translate this call for justice into tangible outcomes, I propose 5 key areas of focus. First, the current global financial architecture is outdated, inequitable, and unjust, and must be reformed to be fit for purpose. We must advocate for debt restructuring that allows African nations to invest in their people and development instead of paying exorbitant interest rates. A just world requires governance reforms in international financial institutions to ensure that Africa has a strong voice in shaping global economic policies. Also, it is imperative to establish an African-led credit rating agency to ensure fair assessments reflect Africa's true economic realities rather than outdated risk perceptions. Second, the African Continental Free Trade Area is a game changer. With a market of 1.5 billion people and a combined GDP of over $3 trillion, it presents an unparalleled opportunity to boost industrialization and trade with the continent. It is therefore essential to fully harness the CFTA's potential to accelerate investments in infrastructure and manufacturing to reduce dependency on external markets.
Curtains closed in the East. Back to you again.
Many thanks for the update there, Tabitha. Prudence is on standby to bring stories from the southern part of the continent.
Thanks, Akin. The Southern African diamond-rich country, Botswana, delivered its budget for the 2025-26 financial year, and the country sees its economy growing by 3.3% this year. My colleague Godfrey Mutiza spoke to the World Bank resident representative for Botswana, Liang Wang, about the country's diversification drive, their view on it, and policies needed to support the economy. Let's listen in for more.
There's no doubt it was a very difficult budget speech. Every budget speech is difficult for a finance minister. But I think for this one was particularly difficult. Let me put it as the minister, the vice president was probably want to hit 3 targets, a triple target, as I may put it. One, he has to weather the current economic downturn. The speech acknowledged the growth will be negative this year. In 2024, and largely because the difficulty in the diamond market. Now, the second target, the government did make promises in the election, and the budget was aiming to deliver. The vice president was also very clear that they want to deliver the promises in a fiscally responsible way, and that's a difficult task. And the third target, the speech also want to hit is to start doing things that will put the economy back on a more sustainable path of growth, and that's also more inclusive. So to make all these things more difficult, it's also a very fiscally constrained environment, and the diamond revenue was much lower from the past years. So to hit all the 3 targets with limited resources, that was a very difficult task. And I think the vice president and the minister came out reasonably well. Yeah. Now, my second takeaway is, despite a lot of the challenges I spoke about being a very difficult budget speech to deliver, the speech covered a lot of grounds, and it does point to a positive direction on a number of things. And let me put just two examples. Yeah. One, the VP repeatedly in the speech talking about fiscal discipline, and in his own words, he said he started by saying, and the government will be stopping the fiscal hemorrhage, right? And those are good efforts to bring the macro stability back, bring the fiscal prudence back, and that's what historically Botswana had been known for. The other example I will give for your audience, Godfrey, is a very clear and a loud message on unburdening businesses and promoting investment. In this instance, the VP actually specifically cited the World Bank's recent business ready indicator as a reference point to guide and improve business development. And those are very encouraging. And my last point is, as people say, the proof of the pudding is in the eating. Yeah. So the real test indeed does come to the new government, to new government's ability to marshal the state machinery to deliver, and while making sure they are also making changes to the government at the same time. So we're all very eager to see. We're also very eager to support where we can to the good efforts articulated in the speech.
And in more news making African headlines and the globe, CNBC Africa's Fifi Peters spoke to Khulekani Mathe, CEO for Business Unity South Africa, for their view on Trump's executive order to cut United States aid to South Africa due to disapproval of the country's land policy and its genocide case at the International Court of Justice against Israel. Let's listen in for more.
The global economy is going through a rough patch because of these developments. Yes, we've been hit with the withdrawal of aid as South Africa, but the noises are threatening various other countries, trade with the US. So it's clearly a lot of concern, around the relationship with the US. But as it relates to South Africa, of course, many have said that the executive order that withdraws aid to South Africa is of no consequence to the economy. Well, our view is that unless a solution is found to this, the impact will ultimately be on the economy when you start to have reinfections, people who don't have access to HIV treatment, and resistance, which could then spiral into an economic crisis. In relation to trade, of course, the executive order did not cover trade, but there are concerns that the American president could start to exclude South Africa from participating in AGOA, which would, of course, affect South Africa and affect sectors of the South African economy that benefit under the AGOA scheme.
Mm-hmm. In response to, it was initially a threat of the withdrawal of US aid, and then it actually became a reality. But the President, Cyril Ramaphosa of South Africa, during his State of the Nation address, saying quite boldly that South Africa will not allow itself to be bullied, not naming specific partners, but the inference was by the US. He also said in that speech, of course, that he'd be sending out various representatives of the country to across the continent, to capitals across the world, just to articulate the country's standing, specifically the messaging and the aim of our G20 presidency. I guess it's a question as to how business stands in terms of our position of not allowing ourselves to be bullied. And are you on one accord with the president in that regard, sir?
We are of one accord with the president as it relates to the engagement. So the president has said that he will be sending a delegation to various capitals to explain South Africa's position. We think that's a correct thing to do. Simply engaging via X or whatever these things are called is not the way to address these kinds of challenges. So we welcome the announcement by the president that he will engage using diplomatic channels to resolve these challenges. And so we fully support that particular stance taken by the president of South African government.
And that's all from the Southern African team for now, and it's back to you, Akin.
Many thanks for the update there, Prudence. And from the western part of the continent, the Executive Board of the International Monetary Fund has approved the immediate disbursement of $46 million to Liberia, stating that broader governance reforms are key to the successes of the country's long-term development prospects. IMF resident representative for Liberia, Joel Chiedu Okwoke, shares more insights.
Early last year, Liberian authorities requested IMF support to finance an ambitious economic plan, which was formalized early this year, and it's called the Arrest Agenda for Inclusive Development, AID, essentially, aimed at improving sustainable growth and inclusive growth as well. The IMF approved the total amount of $210 million in September last year, and this is purely an interest-free resources, which will be disbursed over a period of 40 months from September last year to November 2027. The good news is that the ECF arrangement is progressing well. It has actually started to mobilize additional resources from international financial institutions and donor partners such as the World Bank and the EU. And at the conclusion of the first review, the total amount of $46 million was approved on top of what was already approved at the program approval, bringing the total so far to $51 million, which significantly boosts Liberia's reserves.
Now, let's also walk down the lane of the task ahead for Liberia as we speak today and the strategy around measuring progress around these parameters. You look at domestic revenue mobilization, the expenditure rationalization, addressing financial sector weaknesses, and also tackling governance shortcomings. At this moment, how optimistic are you around these metrics here and the sort of wiggle room the 2025 budget, for example, provides here?
You make a very good point. The starting point of this program really was to reverse the significant deterioration of the fiscal in 2022-2023, which led to depletion of reserves and worsening debt sustainability. Currently the government has initiated a 6.6% GDP fiscal consolidation centered around expenditure rationalization and revenue mobilization, while also protecting priority investment and social spending. We are very hopeful that the fiscal space created will finance infrastructure and human capital investment to boost growth and also create jobs without compromising macro stability and fiscal sustainability. We also hope that the program will, through the program, Liberia will leverage external grants and concessional financing from donors to be able to finance development.
Yes, and we've also seen Liberia also being able to sustain the GDP growth trajectory so far. Inflation and exchange rate definitely has stabilized. But in terms of mitigating any external shocks going forward now, how much of stability do you see going forward, especially on the back of the FX movement we've seen so far and looking at the progression, whether or not the country can really sustain this 5.6% growth forecast you have here in your paper?
The growth outlook for Liberia is promising. We are looking at, 5.6% growth in 2025, and over the medium term, it rises to 6%. This is really far higher than the average for sub-Saharan Africa. So we are optimistic that, if the reform is implemented as agreed on the program, Liberia would, it will improve social outcomes. And let me, touch upon some things that needs to be done on the fiscal side. First, debt is currently assessed as sustainable in our last assessment. However, the overall risk of distress is high. And in that context, we are really, very welcoming of the recent fiscal progress so far, which is bringing debt down. We are thinking that by 2027, the debt to GDP ratio would have declined to 54% as the primary fiscal balance rises to 2.5%. On top of that, prudent debt management strategy would also be very important to preserving debt sustainability. Liberia will continue to, mobilize revenue, and as well as securing external grants and concessional financing from donors to finance the enormous development spending, while at the same time mitigate the risk of crowding out the private sector.
And in other developments, a report by the Mo Ibrahim Foundation shows that despite measurable improvements in governance performance, many African citizens do not feel tangible benefits, particularly in economic opportunities. The report highlights that 50% of public perception indicators do not align with official governance trends. Natalie Della Palme, the CEO of the foundation, unpacks this report.
This research piece relates to the results of our 2024 Ibrahim Index of African Governance, which we just released last October. As you may know, this is an index which assesses the governance performance and trends in each of the 54 countries over the last decade available, which is 2014 to 2033. We aim at assessing the ability of governments to deliver to their citizens a basket of public goods and services. We are not a primary data provider. We consolidate the data provided by almost 50 sources. One key point is that assessing governance performance is about assessing delivery on the ground, not just public expenditure or political commitments. So this is why, along these data that are provided by official data or expert assessments, we include Afrobarometer surveys who provide citizens' opinion in now 36 of these countries. And this is important because what we have seen in our 2024 index is indeed, in many cases, divergences between what is the opinion of the citizens on what's happening in their country, what's happening on the continent, and what the data say. And this is why we have tried to unpack these differences and to explain them. I would say that there are probably several factors to explain. The first one is what we call the expectation effect. The more progress we have or we see, the more expectation raise, and the more dissatisfaction may raise also. This is, for example, what's happening when it comes to economic opportunity. What we see in economic opportunity is that our data show quite strong progress in economic opportunity on average on the continent, +4 points. But when it comes to citizens' opinion, it's a very concerning deterioration of about 12 points.
Now, part of the report says that 50% of public perception indicators do not align with official government or governance trends, with notable disparities in economic opportunities, social protection, etc. This suggests a disconnect between the government and the governed. Do you think that perhaps the challenge is with how the government is interpreting economic data, such as, for instance, the cost of living and health indicators?
Yeah, no, absolutely. I think I first maybe need to explain that when we say official data, it's not the government data.
Oh.
It's data that are coming from 47 different sources that are official in the sense that they are institutional, like IMF or African Development Bank, and expert assessment data. And what we also include in the index, because we think it's key, is the citizens' opinion on what's happening on the ground. So I would say the discrepancy between what we call official data, or let's say non-perception data, and citizens' perception data may have different explanations. When it comes indeed to economic opportunities, which once again is the absolute priority for African citizens, way above probably participation and security and even gender, it's really what are the economic opportunities specifically for the young people who are, as you know, Africa's majority. The expectations are great, and they are great because indeed there has been progress. So we can't say that there has not been progress. What we can say is the more progress there is, the more expectations are growing,
right,
and the more dissatisfaction appear.
Right.
Maybe also, yeah.
I do beg your pardon. If I could just come in here, I wanted to ask you, with a report such as this, what happens next? Do you transmit this report, the findings of this report, to the African governments for them to have a look? What happens after this?
Yeah, absolutely. I mean, this report, this specific report on the analysis of the citizens' expectation is fully available for anyone. But before that, the governance index report is, as soon as it's published, it's immediately shared with all 54 countries. And we are very happy to engage in whatever conversation they want to have about their result, their performances, the trends, or their homologues' performances. So yes, we do share that.
And that's all on this week's episode of Africa Business Weekly. Join us same time next week as we bring you exclusive business and finance developments in Africa. Goodbye. Have a wonderful day and a great weekend.